Scotiabank is one of Canada's largest banks and perhaps Canada's most international banks, very well represented in far-flung areas of the emerging market economies. I'm very, very pleased to be able to speak with Rick Waugh, the President and Chief Executive of Scotiabank. Thank you very much for speaking with us.
My pleasure. I've enjoyed it very much. Thank you.
And it's wonderful to be able to speak to you in your office. It's a very beautiful wooden layout, and it's very, very beautiful to be here in Toronto today. Tell us a little bit about Scotiabank in terms of how an emerging market client could understand what is it that you do, your position in your domestic marketplace, and the rationale by which you internationalize.
Well, sure. Well, by Asian standards, of course, Canada's a relatively young country, but as banks go, we're a relatively old bank. We're almost 180 years old. So the Bank of Nova Scotia, which in our retail operations you'll see us calling us Scotiabank, we've been the same bank for almost 180 years. And so we're, quite frankly, as private banks go, one of the oldest banks in the world. And I think one of the most successful banks. And so obviously our roots were here in Canada, but even from those very early days, we came from Halifax, Nova Scotia. Our executive offices are here in Toronto and have been since around 1910. But we were in many places outside of Canada before we came to Toronto and places into Western.
So you were Canada's original trade bank?
We were. We opened up in Kingston, Jamaica over 115 years ago, and we were in Kingston, Jamaica before we were in Toronto or Montreal.
Well, for an OECD bank, you seem to target emerging markets, and you seem to have exclusively left out the developed markets. So you're not in Europe, you're not very much in the US. Is that a deliberate strategy?
That was absolutely a deliberate strategy. We were all over Europe back in the 80s and the 90s and even into the 2000s, and we decided to consolidate our European operations, and we were in Rome and Paris and Frankfurt and Oslo and Madrid and whatever, and we had branches in Ireland, which we closed, and we had branches in Greece, which we ended up selling. And so we concentrated that, and that was a conscious decision. And let me tell you why. Because again, we've got this great experience in developing and emerging markets and what have you. And we saw it, for example, in Greece. And we had a very good business in Greece, Greek shipping, commercial lending, basically, into that. But of course, with the euro coming, this was still an emerging economy, which we made very good living on spreads, and now they were going to get cheap financing. So that took a lot of incentive out. Secondly, and probably more importantly, the big European banks were going to come in and not have currency risk. And so they would have the advantage of lending into, say, a drachma-like spread instead of a German-like spread, and picking it up, which would not have currency risk.
This is before the euro.
This was with the euro coming, because again, you could lend to Greek government, right, and in euro dollars, and so you didn't have a currency risk. Now you had a transfer risk and a political risk, right, but you didn't have a currency risk, and that's how especially traders looked at it. Well, a euro, I could pick up a euro and pick up 20 basis points more than a euro, right, in Germany.
The two, yeah.
And so all that was happening, and then we had no comparative advantage against the big and strong European banks. This was their backyard. Whereas in the Americas, Central America, South America, obviously North America, Mexico, we had advantages. This was our backyard, and most of these countries, and South America, Central America, it's not all one region. Each country has its own characteristics in that, and the characteristics that we're in are ones that generally have their own central banks, which is very important, and then we can get into that a little bit later. And of course, the ability to make good, sound profitability was very strong. So we made that conscious decision to move out. Similarly, in the United States, over the last several years, we have significantly reduced, certainly over the last 10 years, our exposure, both in absolute terms, and we've closed most of our offices, except a very strong office that we have in Houston, and a very strong office we have in New York that really deals with the Fortune 500, where we have have great, strong relationships. They're all in good shape. And then the energy business out of Houston, because Canadian Bank, Calgary, Houston, and whatever, energy is something we do very, very well. So those are the two areas. But all the other areas in the United States, we're not in. We didn't do the subprime. We're not in retail banking, and we have no aspirations to be in retail banking. So I'm feeling very comfortable on that. And did we see all this crisis coming the way it is? Absolutely not. But there were some basic fundamentals that I think we did get right.
You are yet another Canadian CEO talking about the real economy, in the sense that you keep using this phrase to differentiate yourself from the U.S. For someone looking at Canada from very far away, what would you say is the big differentiator between Canada and the U.S. in today's marketplace? Well,
if you look at the Canadian business model, just the business, we can talk about energy and commodities and whatever, but America's blessed with a lot of resources too. But in our bank, we think one of the best products a banker can provide to somebody is to give them a loan for their home, a residential mortgage. And that is a big part of our balance sheet. Homes to Canadians and homes to people actually in developing countries. But unlike the American model, we don't securitize it. We hold it. And we hold it for some very sound reasons. One, we do the credit analysis. We got very good customers. Our customers promise to pay, and they do pay. So we got years and years of experience about that. But also, and this has also some relevancy to the European banks, our mortgages are good for our customers and they're good for us because they're not 30-year mortgages. You can pay it up over 30 years, but your price risk is a 5-year mortgage rate. So the United States banks couldn't hold 30-year mortgages and 30-year interest rates. How do you fund 30 years? I mean, the Europeans have tried it, and look at the situation they're in now. So we could hold it because we didn't have a funding risk, we didn't have a credit risk, and it was good for our customers because when you borrow at a 5-year rate, it's a lot cheaper than borrowing at a 30-year rate. So they don't have the repricing risk. When rates go up, their price only goes up on a 5-year mortgage versus if you're holding, say, the U.S., your rate goes up on a 30-year, and normally we have a normal yield curve where that if it's 200 basis points increase on 30-year rates, it's only 1% on the 5-year rate. So our customers can handle it, and over the space of the 30 years, you've saved your customers.
Did that become a culture in Canada?
Absolutely.
Over what period of time?
Since I've been in banking 41 years, so I can say it's at least 41 years.
Is that cultivated by the banks, or is that kind of a street culture that came up and the banks had to respond to that?
I think good banks are part of, that's why I say we're a real world bank. So if it's not good for our customers, it's not good for the bank. It's not good for the bank, it's not going to be good for our customers. So, I haven't got a good answer to that. It's because it's not an either or kind of situation. We evolved into it. We got some, we were blessed with a lot of good things. I mean, being next to the largest economy in the world is a good thing. But it also means you got to be a little bit more agile because we also got very strong European roots and we're gaining more and more Asian roots all the time. So being a small country against big Europe and big United States, we had to do it. So we do our things. I call us American Lite. Right. Okay, because we have a lot of the same values. We believe in democracy. We believe in open markets and whatever. Great admirers of that. We try to also follow the innovation and the technology and whatever. But we do things our own way. We have our own currency. We have our own central bank. We have our own political system. We have our own educational system, which is different than that. I'm not saying better or worse, but it is different. Our medical system. Our taxes, and this is why Canada's, the dollar and the Canadian rand, these things like education and medicine are already in our tax base. Maybe not as much as they should, and we're going to have challenges funding going forward, but we've crossed that bridge of doing that. Our interest rates, our interest on mortgages are not deductible. The Americans are stunned because, of course, an American mortgage is deductible. Well, when you use the tax system, that's how you get bubbles in certain asset classes. So we've gone over all that because, our Canadian customer doesn't get an interest reduction on his mortgage. So when we do our coverage ratios and our service ratios, that has an impact. So there's all these differences.